We have been dealing with Unit 5, and under Unit 5 about the various kinds of financial services. We had started talking about venture capital. And when we started with venture capital, we learned about the meaning of venture capital. We saw how the term venture capital is actually divided or composed of two words, venture and capital. Venture meaning a sort of an adventure or something new, and capital, of course, meaning the finance. So venture capital, in simplest of terms, means providing finance to these companies which are opting for new kinds of techniques or new methods, some rapidly growing industries or companies which have a high potential for growth. Okay, and then after learning the meaning, we saw also the various features of venture capital, and then we also saw the different types of venture capitalists and the methods by which we can get venture capital financing. And we also saw a few areas in which venture capitalists tend to invest in, and mostly we see that when it comes to areas of investment, mostly it's relating to these areas which require amount of technologies such as medical services, communications, electronics, software companies, all these kinds of companies. So moving ahead, today we will start with discussing the different stages for venture capital financing. What are the different areas of the life of a project or of the life of a company in which venture capitalists will start financing? So generally, venture capital firms, they usually recognize two main stages for the investments. Okay, there are mainly two main stages with regards to venture capital financing, and these stages are termed as early stage financing and the later stage financing. And early stage financing is basically the type of financing which is done when the company is just starting up or when the company is just starting to grow. Okay, whereas later stage financing is the financing which is provided when the company is already in existence, it already has few loyal customers, but they still need financing in order to grow or in order to develop even further. So firstly, let's look into the first section, which is early stage financing. So when we're talking about early stage financing, as I've said earlier, it is for the initial stages when the company is still just starting to grow. So this stage basically includes finance for seed capital, and then also for research and development projects, and then you have for startups, and the third situation is in case of second round finance. So let's look into these one by one. Firstly, look at seed capital and research and development projects. The seed stage is basically when a startup will approach an angel investor or any other venture capitalist, also a venture capital firm, in order to seek finance for their idea or prototype. Okay, so at this stage, the startup, they may or may not have a commercially available product yet. They will not have a product, they would just have an idea of what they want to sell, and they are focused mostly on convincing the potential investors why their ideas are worthy of a venture capital support. Okay, so just like when you're planting a tree or planting a flower, also you need to start with a seed, right? So here also, when they want to plant a company, they're going to start with seed financing, something that will help them to grow in the future, something that will help their products to grow in the future. So the term or the description seed is very much appropriate here because it suggests that the money that is available will fuel a startup's growth down the road. Now, at this point, the leaders of a startup, as we've said already, they may or may not have a product. Okay, so they will be having just an idea of what they want to build up, and their main concept or the main purpose here right now will be just to get the financiers, to get the venture capitalists to finance their ideas to show that they are capable of growing sometime in the future. Okay, so venture capitalists also are more often interested in providing seed finance or to provide provisions of very small amounts of finance needed to turn into a business. They are very much into the idea of seed financing because it doesn't involve a lot of money. And when we're talking about seed financing, the entrepreneur should convince the investors why the ultimate product will be viable and successful in the market, and the potential investor will then, that is your venture capitalist, will then investigate the various technical aspects of the product and the economic feasibility of the idea, and then after that they'll decide whether or not to invest in the product. Okay, so seed stage financing is usually quite modest in comparison to your later stage financing. Early stage financing is when you're just putting in a little little bit of money just to help out. Okay, so it is quite a small amount and it doesn't require a lot of amount as compared with your later stage financing. And the financing that is provided towards seed capital can be used for product development, market research, or it can even used for building an entire management team. All right, so that is about seed capital. And seed funding usually are typically small and they're channeled towards your research and development also. So research and development activities are activities which are required to be undertaken before the product is to be launched, right? And for that also we need finance. So seed capital can be provided not just for setting up of the enterprise, not just for promoting the goods, the services, but rather it can also be provided for research and development that is going to be required for creating a product. Now, external finance is often required by the entrepreneur, especially during the development of the product. And the financial risks will increase progressively as research phase moves into the development phase. The more after you've decided what to do, they're going to increase, the risks are going to be increasing, because next you have to plan about how to develop the product further, and then the risks increase in the form of costs. Okay, you'll have to invest a lot in when you're going to produce a product, right? So all of these are required. Early stage financing, you require seed capital, and using the seed capital you can also promote your research and development projects. All right, so that is the first stage of financing under the early stage. And secondly, in case of startups, so startup capital is quite similar to seed stage, and with initial market analysis conducted and your business plans having been put in place, companies then will start to look to the towards starting the marketing and also the advertising of the product, and also the acquiring of your customers. Okay, so the most risky aspect of any venture capital is the launch of a new business, especially after research and development activities have been completed. Okay, so as you've said, seed capital is first step, startup is the next. Seed capital is where you're coming up with the idea. Startup is when you're trying to sell the idea. So if the idea or the product appears to warrant further investigation or investment, then the new company will then advance to the startup stage. And startups typically have a sample product available at this stage, but they will still need funding for better product development. They have the product that they want to sell, but because due to lack of financing, they are unable to give you the best product that could be made. Okay, maybe they've just made something as a prototype, something just to see, but not the best product that money can buy. So startup will also use funding to conduct initial market research in the product, and the venture capital firm will obviously want to see results of market research in order to determine whether the market size is going to be big enough and if there are going to be enough customers to buy the products. Okay, so there's always a problem that people may or may not buy the product. So it is during the startup capital stage where the venture capitalists will study, the entrepreneur will study at this stage, the entrepreneur and the products will be untried, right? It'll just be a new product. People would have not yet invested, consumers would not be there for the product. So it's during this stage that the venture capitalists will see whether or not the product will be worthy, marketability. Okay, so the finance required will usually fall short of the own resources of the entrepreneur, and as a result of that, they are going to require startup capital. Now, startups may include new industries or businesses which are going to be set up by experienced persons in the area in which they have knowledge. Now, others, they may result from research bodies or large corporations where a venture capitalist will join with an industrially experienced or even corporate partners. However, still, other startups occur when a new company with inadequate financial resources to commercialize new technology is going to be promoted by an existing company. And organizations at this stage will already will require venture capital financing in order to carry out market research and also in order to improve their products further. All right, so under early stage financing, the third point you see, second round financing, or it's also termed often as second stage financing. So second round financing basically refers to the stage when the product has already been launched in the market, but it has not yet earned enough profits to attract new investors. And as a result of this, additional funds are going to be required at this particular stage in order to meet the growing needs and also the demands of the business and the consumers at large. Now, at this stage, the product or service has been developed and it is being sold in the market. As a result of that, this is the first opportunity the investors have to see how the product will be accepted by the customers and also how the product fares in comparison with the competitors in the market. And the funding received at this stage will often go towards manufacturing, sales, and even additional marketing. And the amount invested in this stage is normally a little higher than the prior two stages. That is, it is under your second round financing or early stage financing, it is a little higher, the finances, as compared with seed capital and startup capital. Okay, so at this stage, the company could also be moving towards profitability depending upon the share on the marketplace. At this point, they may start earning profit. And venture capital institutions, they will provide larger funds because in the form of debt. Okay, so the time scale of investment under second round financing is usually between 3 to 7 years. And if the startup and its products can hold its own against the competition, then the venture capital firm will probably give a green light for your next stage. It is only after they've studied the second round financing, after they've studied how the customers are reacting towards the product after the market research from the second round financing, then they'll decide whether or not to move to your later stage financing. Okay, so remember, under the early stage financing, it's mostly when you're just starting up. So it'll be seed capital. When you're just starting with the product, you have the idea, you don't have the product yet. And then you have your startup capital when you have the idea and now you have the product as well. And then second round finances when you have your idea, you have your product, and you also have 1 or 2 customers. Okay, so this is early stage financing. So now moving on, you have your next category there, your later stage financing. So those established business which require additional financial support but which cannot raise capital through public issue approach, the venture capital finances for financial expansions, buyouts, turnarounds, and also for development capital. Okay, so later stage financing is basically for your firms which are already in existence in the market, but they are unable to raise their own capital through IPOs or through getting through loans and through other debt instruments. Okay, as a result of that, they will often go to the venture capitalists in order to get finances. So under later stage financing, let's look at the first one, development capital. So in case of development capital, it basically refers to when you need more capital in order to grow further. Okay, so basically it refers to financing of an enterprise which has already gone through, it has overcome all of these highly risky stages, and they've already overcome the initial stages. They already have some customers, they have a steady growth, but however, they have also recorded profits. Okay, but however, they are unable to go public yet. Okay, maybe they have not met the requirements as per the stocks exchanges, as per SEBI, as per RBI. Maybe they haven't met the requirements yet. So because of that, they are not able to list their company in the stock exchanges yet. Therefore, they will need financial support to grow further. So funds are generally required for the purpose of purchase of new equipments or plants, or maybe even for the purpose of expansion of marketing and also for their distribution facilities, and maybe for launching products into new regions and so on. So basically, development capital is required for purchasing of your assets, and then also for maintenance of your assets and for diversification and product expansion. Okay, so the time scale of investment under your development capital generally ranges between 1 to 3 years, and because they have already passed the highly risky stage, this type of development capital is recorded or is termed as medium risk category. It's not very risky for venture capitalists to finance the companies which want development capital. Okay, and moving on, the next under later stage financing is your expansion. And the second stage under later stage financing is your expansion finance. So growth is exponential by this stage, and accordingly the finance from a venture capitalist will basically just be adding more fuel to the fire. Okay, at this point companies are already growing, they're earning profits, and the finance that is going to be provided by a venture capitalist is basically just going to be just adding more oil to an already lit fire. Got it? That in a sense just helping to increase what is already growing. So they enable the expansions to with the finances that is provided by your venture capitalist will enable expansion to additional markets, that is maybe even to other cities or even to other countries, and will also lead to product diversification and differentiation also of your product lines. And venture capitalists at this stage, they will perceive low risk in ventures which require finance for expansion purposes, either by growth implying bigger factory, larger warehouses, new factories, new products, new markets, or through purchase of existing businesses. Okay, in fact, even acquisitions, for the purpose of acquisitions also, you can opt for venture capital financing. And additionally, when we're talking about your expansion finance, the time frame of investment is usually ranging for, it's a short period between 1 to 3 years, and generally this expansion finance represents the last round of financing before a planned exit. The expansion finance, one thing to remember is that you are going to be able to ask for expansion finance only if your company is earning good profits and revenue. Okay, always remember, expansion finance is possible only if the company is earning good profits and revenues, and the expansion will give the venture new wings to enter into untapped markets. As we've already said, it's for growing the market that you are, it's for growing your business. So it could be for launching of a new product, for product diversification, for product differentiation. Okay, for all of these things, you can opt for expansion finance. And generally, expansion finance is usually the last stage before you start to go for the IPO. And even at this stage also, the venture capital firm will still evaluate and see if the management team has made the expected cost reductions and how the startup is doing when compared with the competitors. Again, okay, it will always compare it with the competitors to see whether or not they should be receiving any sort of financing from the venture capitalists. Okay, and next you have replacement capital. A major part of investment by venture capitalists is made towards purchasing the existing shares of the owners. Okay, so whatever owners you're having, those who are there in the business, some portion of your venture capital finance can be used towards purchasing the shares that they are holding. So this may be due to a variety of reasons, which could include maybe personal need of finance and then conflict in the family, or maybe a need for association of a well-known name. Okay, so venture capital institutions also do provide finance for purchasing existing shares of the owners, and though initially it may not result in any new business, yet a partnership in future growth does often result in the development of new businesses, and the time scale of investment under replacement capital is generally 1 to 3 years, and it is not very risky. Okay, it involves a very low risk because you're not going to invest in a new market, you're not starting a new market, you're not going to be introducing any new products, and as a result of that, there is no risk involved. Basically, the only problem is you are just going to be buying off the shares of your existing owners. Therefore, it is not a very risky source of a form of financing. And then you have the fourth stage there, turnarounds. A turnaround or recovery case requires much specialized skills, and such form of venture capital financing, it basically involves medium to high risk and involves time of between 3 to 5 years, and it involves buying the control of a sick company, which requires very specialized skills. Okay, as you've said earlier, it turnaround or require a recovery case. It's also termed as recovery case, and it requires specialized skills because it involves buying the control of a sick company. And it may need a renegotiation of all the company's borrowings, change in management, or even a change in the ownership altogether. And a very active hands-on approach is required in the initial crisis period, where the venture capitalist may appoint its own chairman, or they may even nominate its directors on the board. So basically, when I'm talking about turnaround, it's mostly involving the buying of a sick company. And when you're buying a sick company, you become the ultimate owners of that company. So it generally involves also a change in the ownership, change also in the various other activities also, not just the ownership, borrowings of a company, change in the management also. And as a result of that, it's also a very hands-on approach, meaning the venture capitalists will be acting almost as a type of the management. Okay, they'll also be acting as the management, and they'll be dealing with, or they'll be handling all of the dealings of the company. And it could even lead to a point where venture capitalists may appoint their own chairman, or they may even nominate the board directors to the board of the company. Okay, and finally you have buyouts. So buyouts basically refer to transfer of management control by creating a separate business, by separating it from its existing owner. So what exactly is a buyout? Now, a buyout, it refers to an investment transaction in which one party acquires the control of a company either through an outright purchase or by obtaining a control of the equity interest, that is, by owning at least 51% of the company's voting shares. So when you're talking about buyouts, there are generally two types of buyouts. One is the management buyout, and the second is the management buy-in. So when we're talking about management buyout, venture capital institutions will provide finance to enable the current operating management or the investors to acquire an existing product line or the business. So basically it involves providing finance to the management or to the managers in order to buy out the shareholders or to buy out the owners of the company so that the management can acquire the existing business. And they represent a very important part of the activity of your venture capital institutions. So in case of a management buyout, remember, we are going to buy out the owners of the company. Okay, we're going to buy out the owners of the company, and the original managers will become the owners of the company. And the second type of buyout is known as the management buy-in. So in case of management buy-in, the financiers, the venture capitalists are going to provide funds to enable an outside group of managers to buy an existing company. They will buy they'll buy a way into the new company. Okay, so the outside managers will buy a way into the company, whereas in case of management buyout, the managers will try to find a way to buy out or to throw out the original owners. And in case of management buy-in, the outside managers will come into the existing company. Now, in case of management buy-in, it generally involves three parties: a management team, a target company, and an investor. And the investor under this case will be your venture capital financer or your venture capital institution. And management buy-ins are going to be more risky than management buyouts. Therefore, they are not as popular as management buyouts because it's quite difficult for new management to assess the actual potential of the target company. And in case of management buy-ins, because we don't know the company that we're going to buy, whether the company is a healthy company, whether the company is going to be profitable sometime in the future, so it's quite risky and people do not often go for management buy-ins. So usually management buy-ins are able to target the weaker or underperforming companies. However, if you want to acquire companies, management buy-in is one of the best options rather than the management buyout. So these are the two stages with regards to venture capital financing. And venture capital funding is a very important source of financing, especially to new startups which have new ideas. Okay, so always remember, in a nutshell, basically venture capital firms, they provide both the early stage financing as well as the later stage financing, depending upon the requirements of the firm and also based upon the availability or the want of the venture capital financer to accept the risk and also the returns for the risk taken. So venture capitalists will evaluate the technology and they will study the potential markets, besides also considering the capability of the promoter to implement the project while also undertaking the early stage investments. So in the later stage investments, new markets and track record of the business or entrepreneur will be closely examined. So when they are providing finances, in case of the early stage, they're going to study first whether the project is going to be viable for their investments, and at the same time they'll study whether the owner, the promoter of the company business is going to be capable enough to promote the product that they're having, okay, to implement their project in the market. And later, in the later stage investments, the venture capitalists are going to study the market and also track record of the business and how they are dealing with the customers and their products. Okay, so these are the stages of venture capital financing. And then you have factors affecting the investment decisions. So even when they are investing also, the venture capitalists are going to keep in mind a few factors when they are making their investment decisions. So firstly, strong management team. In order, when you have money, if you want to invest in a firm, one thing you should remember is to ensure that the people who are going to be using the money are going to be capable enough of giving you proper returns. Okay, so you require a strong management team. And venture capital firms, they ascertain the strength of the management team in terms of adequacy of level of skills, and then their commitment level, motivation that creates a balance between members, and in the areas such as marketing, finance, operations, research and development, and all of these various other ideas. And then the track record of promoters will also be taken into account before they start investment. And secondly, a viable idea. Remember, in case of venture capital, we said it is the money that is provided for an idea to take place. So you need to have a very good idea in order for the venture capital to finance your ideas. So before taking any investment decisions, the venture capital firms will definitely consider the viability of the project or the idea, because a viable idea will establish the market for the product or service. So they will always ask these questions before they invest. Why will the customers purchase the product? Who are the different customers who are going to purchase the product? What is the target market? And do you have any competitors? And how much will be the projected growth of the company? And the third factor to be kept in mind is the business plan. So the business plan should concisely describe the nature of the business, and then the qualifications of the members of the management team, how well the business has performed, and also business projections and forecasts. And the promoter's experience in the proposed or related business is a very important consideration, and the business plan should also meet the investment objective of your venture capitalists. And the fourth point is project cost and returns. How much is the risk and how much is going to be the return? Okay, so the venture capitalists would always invest in a venture only if future cash inflows are likely to be more than your present cash outflows. So you've already learned financial management, so you understand these terms, right? Cash inflows and also the present cash outflows. So they're going to invest only if their 1 rupee is going to be converted into something that is more than 1 rupee. Okay, so the current investments that have made should be more than their should increase when they're getting the cash outflows. So while calculating the internal rate of return, the risk associated with the business proposal, and then the length of time the money will be tied up, all of these are taken into consideration. Okay, that is how risky the work is, and then how long they've invested, what is the rate of return that they're going to be getting after that specified amount of time. Additionally, project cost, and then methods of financing, sources of finances, cash inflows, all of these are also going to be closely studied. Then the fifth factor which affects investment decisions are your future market prospects. So not just the current market, but how it will deal in the Therefore, the marketing policies that are adopted by the firm, then the marketing strategies, and then comparing the market strategies with the marketing strategies of the competitors, market research, market size, future market prospects, all of these are also considerations that are going to be taken for making the investment decisions. And the sixth point is existing technology. So the technology that is being used by the firm, and then any technical collaboration agreements entered into by the promoters, these are also decisions, these are also factors which affect the investment decision, because how you are dealing with the technology. If you want to create something, you cannot be using something that is old, right? You cannot be using old technology to create something new. Therefore, they are also going to keep in mind the usage of technology. And the last point is miscellaneous factors, that is other factors. So other factors which may affect investment decisions could include availability of raw material, and then availability of labor as well, then the pollution control measures, government policies, rules and regulations, that is all those business laws, whether they're following them or not, and also the location of the industry. Okay, all of these are also considerations which affect the decisions of your venture capitalists. All right, so these are the factors which affect the investment decisions of your venture capitalists.